Back on May 14th, Cerebras Systems was listed on NASDAQ at $185 per share, the largest U.S. tech IPO since Uber in 2019. By day 3, it hit $311, a 68% surge in 72 hours. It is now valued at roughly $70 billion, built on one piece of technology, the Wafer Scale Engine, a chip the size of a dinner plate that runs AI inference faster than Nvidia on specific workloads. Today, on June 23rd, Cerebras will report its first quarterly earnings as a public company after the U.S. market closes. But here's the thing, Wall Street expects a loss. The stock has already given back 27% from that $311 peak, now trading at $226. And buried in the IPO filing, 86% of Cerebras' full year 2025 revenue came from 2 government-linked entities in Abu Dhabi. Both of those things are true. The hottest AI chip debut in years is built on a single geography, reporting a loss, and has already slid 27% from its opening high. So, is this the entry point, or is the hype catching up with reality? In this video, I'll cover what the Wafer Scale Engine actually does and why the speed advantage matters, what their $20 billion deal with OpenAI looks like when you read the fine print, what the Abu Dhabi concentration tells you about the business model, and what today's earnings call will reveal. My name is Phoebe, and you're watching Trading Key. Key technology that makes Cerebras different. The standard approach to building a chip is to cut a silicon wafer into hundreds of individual die, test each one, then connect the working ones inside a server. This is how Nvidia builds the H100, the A100, every GPU in the Blackwell generation. Well, Cerebras does the opposite. The entire wafer is the chip. One processor, the size of a dinner plate, with 4 trillion transistors and 900,000 AI cores on a single piece of silicon. So why does that matter? The bottleneck in running large AI models isn't raw compute, it's memory bandwidth, how fast the chip moves data between processing cores. When a model fits entirely on a single Cerebras chip, inference runs without touching external memory. No data leaves the chip, no bottleneck. For large language model inference, Cerebras claims speeds up to 20 times faster than an equivalent NVIDIA setup on specific workloads. The catch, however, is yield. When you cut a wafer into individual die, defective ones get thrown out. When the whole wafer is the chip, one defect anywhere can compromise the whole piece. Cerebras engineers around this with redundancy architecture, but it's a harder manufacturing process than NVIDIA's, and it limits production volume relative to demand. The tech is real. The speed advantage on inference is real. The question now is whether that advantage is enough to break NVIDIA's grip on enterprise AI. After all, NVIDIA's edge isn't just the chip, it is CUDA, the software ecosystem that every AI developer has been building on for over a decade. Switching away from NVIDIA means rewriting code, retraining teams, rebuilding tooling. Cerebras has to clear that bar regardless of how fast its chip runs. The $20 billion OpenAI deal. In January 2026, Cerebras signed a master relationship agreement with OpenAI for $20 billion, covering 750 megawatts of AI inference compute, with an option to expand to 2 gigawatts by 2030. As of December 2025, Cerebras had $24.6 billion in remaining performance obligations on its books. The OpenAI deal is the majority of that. Now, this is the bull case in a single number. If the most commercially important AI company in the world is committing $20 billion of compute to Cerebras, it signals that Cerebras has something NVIDIA cannot or will not provide at competitive terms at this scale. However, a multi-billion-dollar contract with one customer isn't a diversified revenue stream, but potentially a very expensive single point of failure. After all, OpenAI is both the most important partner Cerebras could have and one of the most dangerous customers to be dependent on. If OpenAI delays the build-out, renegotiates terms, or shifts to a different provider as NVIDIA's Blackwell pricing gets more competitive, Cerebras' revenue profile would change overnight. The remaining performance obligations figure tells you the contract exists. It doesn't tell you the pace of deployment Or what happens if OpenAI's own financial situation shifts? Of course, the same concern is applied to Cerebras' previous concentration, which brings us to the number the headlines have mostly skipped. 86% of CBRS revenue is from Abu Dhabi. In fiscal 2025, the Mohammed bin Zayed University of Artificial Intelligence in Abu Dhabi accounted for 62% of Cerebras' total revenue. G42, a UAE technology group, accounted for another 24%. Together, 86% of the $510 million Cerebras earned last year came from a single country and two government-linked entities. This is the defining fact about what Cerebras was before the OpenAI deal. Now, the OpenAI deal changes everything. A multi-billion-dollar agreement with the world's leading AI company is a different anchor than two Abu Dhabi institutions. The customer quality is higher, and the use case is more central to where AI infrastructure is heading. But here's what doesn't change. Cerebras is moving from two dominant customers in one geography to one dominant customer in another. Progress, not diversification. The underlying pattern, where a business is anchored to a handful of relationships rather than a distributed enterprise base, hasn't shifted. And the CUDA moat means every enterprise customer Cerebras wants to win has to weigh the real cost of moving away from a platform their entire team already knows. What today's call needs to show is not just whether Q1 revenue beat the $56.65 million consensus. It is whether management can name new customers outside the OpenAI relationship. That is the signal that tells you whether Cerebras is building a real business or still managing a high-value contract. Is Cerebras worth buying at $226? CBRS is down 27% from its IPO peak, though let's be honest, that isn't unusual for a company reporting first earnings into high expectations. What matters is what happens next. In scenario A, today's call reveals that the OpenAI ramp is ahead of the original timeline, and management names 2 or 3 enterprise accounts outside OpenAI in late-stage discussions. Gross margins are expanding. The wafer scale speed advantage is proving out at commercial scale. In this case, the slide from $311 to $226 is a buying opportunity, and the stock recovers quickly. In scenario B, the OpenAI deal is real, and Q1 is in line, but the call offers nothing new on customer diversification. The stock stabilizes. You hold a profitable company with a $20 billion anchor contract and a genuine technology edge, but the valuation at $226 requires the business to expand well beyond its current customer base. Patient investors stay in. Short-term traders find no catalyst. In scenario C, the OpenAI ramp is slower than implied by the $24.6 billion performance obligations figure, or management cannot name new wins, or gross margins disappoint. The stock retests the low $180. Concentration risk becomes the dominant story, and the IPO hype looks exactly like what the skeptics said it was. So, which of the 3 scenarios mentioned is the most likely to happen? Takeaways from Cerebras' first earnings call. Here's what we know for certain. 1. Cerebras has real tech. The Wafer Scale Engine isn't a marketing slide. 2. For a company that went public 6 weeks ago, the $510 million in 2025 revenue and $237.8 million in net income are real. And 3. The $20 billion OpenAI deal is real and the contract is on the books. And so the investment risk is structural, not technological. Cerebras has spent its entire operating history serving a very small number of customers, and it is now making the transition from one concentrated relationship to another. That transition needs visible enterprise diversification before the $226 valuation holds up on fundamentals. The conventional case says buy the dip into earnings. In practice, however, the history of high-profile tech IPOs says the real entry point tends to arrive 6 to 12 months after listing, not in the first quarter of trading. The lockup expiry later this year will bring additional selling regardless of what today's report shows. And that creates a more rational entry point than $226 for investors who want Cerebras but are not ready to carry the concentration risk at full price. So tell me, are you buying before the results drop, waiting for what the call reveals, or sitting this one out entirely? Let me know in the comments below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.